Thank you. Hi, everyone. I'm so honored to be the first panel moderator for our second conference, which, as you can see, it's very, very high quality. I've been to a lot of conferences in my career, and this really tops the list, so thank you very much for coming. So today, my name is Hugh, Chief Investment Advisory Officer. I look after the investment office on a day-to-day basis. Today, we're going to discuss how to navigate the high interest rate environment on a long-term basis. I'm sure this is on the minds of a lot of investors right now. As of yesterday, the 10-year actually hit very, very close to 5%. I believe it was 4.99. Over the last 3 months, we've seen the 2-year and the 10-year really what we call bear steepen. I think more than 100 basis points. So a lot is happening in that space, and this subject is really the top of our minds. So without further ado, let me start by asking our panelists to maybe make a very quick 30-second introduction, maybe starting from Wenting.
Sure. Hi, everyone. Really great to see the full house here. My name is Shen. I am a multi-asset solution strategist and portfolio manager from T. Rowe Price. Excuse me. I was with BlackRock before. So I'm also part of the Asia Regional Investment Committee. So my job is really to design and manage, customize the mandate for our clients in the region, bring out the best of T. Rowe Price investment capabilities. And as I already sort of alluded to, I joined T. Rowe Price from BlackRock. I was with BlackRock for about 8 years before T. Rowe Price.
Thank you, Wenting. Alice?
Hi, everyone. Very nice to be here. My name is Alice Low, and I'm head of the Singapore retail business at PIMCO. My role primarily involves working with partners like Endowus to bring PIMCO's solutions and our thought leadership views to our end investors. I've been at PIMCO for about 7 years currently, and I have a total of about 17 years of experience.
Thank you. Sien?
I'm Sien, or Sien. I'm responsible for BlackRock Asia Pacific's product strategy for fixed income, with a focus on just broad index anywhere in the world where we find opportunities for our clients. I spent half my BlackRock career, 4 years in the London office, and then 4 years moving closer back home, which has been the best decision ever. Reconnecting with ex-colleagues like Wenting and many faces I see across the room, actually. Looking forward to catching up. Like Gregory, I'm also very excited from what I can see happening already in the European space, and that wealth pivot to more bonds, more kind of institutional-like, more democratization of investing. I think that's why we're here.
Hi, everyone. I'm Hilda. I'm the Asian Fixed Income Investment Director from Schroders. Joined Schroders about 2 years by now, and in total about more than 8 years of experience, mostly focused within the Asian credit space. So within Schroders, I kind of represent or front our Asian credit range in front of clients, and also mainly representing our portfolio managers in terms of their views, how they're positioned, and really just working with key partners like Endowus in expressing our views within this segment.
Thank you. I know we're very tight on time, so we're going to try to be really quick. Starting from Wenting, you're a multi-asset solution strategist, so I'm sure you're familiar with equities and bonds. So in this high interest rate environment, what is your view on how to allocate between equities and bonds? And in particular, as we look into retirement, a lot of people are looking at the high returns you can get from cash-like products right now, money market funds. So what would be your kind of view on or recommendation on how you asset allocate during this environment?
That's a very spot-on questions. I think it's relevant to all of us. And I'll break down the question into the 2 parts. I'll talk about the asset allocation between equities and bonds first, and then I'll talk a little bit about the choice of money market funds for retirement savings purposes. So yes, we are having high interest rates right now, and understandably, it is a concern for many investors. But we shouldn't be bearish just because interest rates are high. And if you look at the history, a lot of the times we had the Fed funds rate above 5%, but the market still has plenty of life to go. And just because the interest rates are high doesn't mean it will suck the oxygen out of the system. And in fact, yes, we are probably at the highest interest rate environment since global financial crisis. But looking back into the history of capital markets, there were decades that had interest rates higher than 5%. This year, a lot of people are getting excited about AI. And if the market continue to be excited about the productivity gain from AI, then the market could go even higher. So going directly to the asset allocation decisions between equities and bond, let me give you our conclusion first. So in our multi-asset portfolios, we maintain a modest underweight position in equities and have an overweight position to bonds and bonds and cash. But here is a twist. We actually think Q4 could be a window for risk assets to do well, with a combination of resilient US economy, our historically strong seasonal period, and also a potential rebound in investor confidence, given that there could be potentially a change of global monetary policy trajectory. So that seems to have a disconnect between our views and our positions, and let me explain why. We actually think high yield could be a very attractive alternative to equity in any multi-asset portfolios. Historically, high yield has shown high correlation to equities, but it definitely has a significant yield advantage to equities at the moment. To top it up, the default rate, even though it has increased, but is still low relative to the long-term average. So as a result, we hold an overweight position to high yield and underweight position to equities, but from the equity beta perspective, we are neutral. So going into 2024, even though probably in the short term, the economy is still going to be resilient, but we think the uncertainties will only go up from here. The market pricing currently reflects a softer lending scenario, but that sets us up into an asymmetry into 2024. If we ended up with a softer landing, great, but it's already reflected in the pricing. If we ended up with a hard landing, guess what? It's not reflected in the pricing. The fading of fiscal stimulus and policies effect could start to show even more next year. So as a result, our position is that it's not a time to be a hero. And in our multi-asset portfolios, we're not taking large active positions because of the heightened risk and the wide range of possible outcomes. Then going to your second part of the question about retirement, I can totally relate to those investors who think that putting your hard-earned money, particularly for retirement, into money market funds is great because it's risk-free. But having said that, Hugh, let me ask you a question. If I tell you the expected return for cash over the next 5 years is 3.9%, but the expected returns for global equities is as high as 9.4%, would you still be happy to stay in money market funds and give up the upside in global equities?
I think you know what my answer is. No.
Yes, but you might be asking me a question. Oh, how about I enjoy the high risk-free rate for now, and when the interest rate comes down, then we'll switch out.
Yep.
Fair enough. But there are numerous studies that have shown that market timing is notoriously difficult. And if you look at the behavior pattern of individual investors, they tend to buy high and sell low, the exact opposite of what we should be doing. And in fact, on this exact topic, the Department of Labor in the US has concluded long ago that money market funds are not qualified as default options for defined contribution schemes in the US because over long term, cash or cash equivalent principal guaranteed products, or you name it, they are not going to be able to produce as favorable of rate of returns as other qualified investment products, such as target date funds. and that will decrease investors' likelihood to save enough for their retirement over time.
Yep. No, thank you so much, Wenting. With that related question, I'm actually going to go to Alice. It is a related question in the sense that in this environment, risk-free returns are 4 to 5%. A lot of the kind of safer bonds are giving you only maybe 1 to 2% higher returns. So from a perspective of PIMCO, how do you think about that? How does it justify going into these bonds? And in particular, I think PIMCO is also very much into structured credit. Is there a difference between corporate and structured credit risk-reward in your view?
All right, thanks, Hugh. So if I can rephrase the question slightly, I think the first part of the question is asking why should investors consider bonds over cash right now? Yep. So on that question, I think there are 3 key reasons why investors should consider bonds over cash. Number one, obviously, is the yield advantage. You just mentioned earlier that bonds are out-yielding cash, risk-free assets right now, albeit 1 to 2 percentage points higher, but it's still higher nonetheless. And historical data has shown that there is actually a 94% correlation between the starting yields in bond markets and the expected forward returns. So the high yields that you're experiencing in bond markets right now actually bodes very well in terms of expected returns for bond investors from here on out. And then number 2 is that you also give up the upside when you're staying in cash versus bonds. So there is no capital risk per se, but there is reinvestment risk for cash. If you look at currently what the markets are pricing in right now, markets are pricing in the Fed to start cutting rates in Q2, Q3 next year. So you do expect that rates will start falling. And if you are in cash right now, there is actually reinvestment risk. If you put a 6 months fixed deposit, when the fixed deposit matures, high chance that you can't roll it into another fixed deposit at current rates. Versus bonds, where if rates starts coming down, then there's capital gains that can be made in the bond markets. Now, of course, one key question that Wenting also talked about is market timing. A lot of clients may ask, why don't we just wait until the Fed is done with the rate hikes and then we start to enter the bond markets? But again, we've actually surveyed historical data. If history is any guide, if you look at data going back to the 1970s, and we survey rate hike cycles across developed markets, we've actually noticed that as early as 1 to 2 quarters before the peak rate hikes, in the rate hike cycle, bonds actually start to outperform cash on a 1-year basis. And that's because, again, rates have actually gone up, so returns in bond markets actually outstrip that of what you can get in cash. And then even if in the scenario where we've looked at also different past rate hike cycles, be it when the Fed cuts immediately, higher for longer, or a pause and then a cut, so different types of scenarios. In all scenarios, bonds actually outperform cash over, say, call it a 2 to 3 years time horizon. So we think that for the patient investor right now, bonds actually make a lot of sense from a return standpoint. So, and the third point is that bonds also provide a very good downside hedge against recession as compared to cash. At PIMCO, our base case is calling for recession in the next 6 to 12 months in our cyclical horizon. And that's because our expectation is that fiscal policy will start to recede, and the tighter monetary policy will start to drag growth downwards. So we do think that in our base case, there's going to be a mild recession coming in our cyclical horizon, and that's where bonds will provide a very good positioning and hedge against your riskier assets in your portfolios. So we do think that all in all, bonds actually play a very important role right now and offer very attractive value versus cash. To your second question about how we view corporate credit versus structured credit at this point in time, given our base case where we do see elevated recession risk, we are a bit more cautious on corporate credit. In particular, some of the riskier segments of the corporate credit market, so for example, high yield, particularly lower rated, as well as some of the legacy private credit as well, where we see that these shorter duration of floating rate assets, given the high interest rate environment now, we are starting to see a bit of signs of strains, given the higher funding cost. Where we are favoring would be higher quality investment grade credits within corporates, And in particular, our high conviction is in the structured credit space, high quality assets with very resilient cash flows backed by your hard assets. If you look at valuations as well, we also find that structured credit looks a lot more attractive as compared to corporate credit. So take, for example, right now, across many different parts of the structured credit markets, valuations versus the 10-year average are at their top quintile, versus IG bonds right now, IG corporates, where they are around about fair value. So overall, our preference is still very much for structured credit.
Thank you. So both Alice and Wenting agree that we should stay invested other than cash. Now, moving on to Sien. In terms of duration, I think that's a question that comes up a lot. Obviously, the longer duration treasury products have really drawn down a lot over the last few years. What is your view and what is your recommendation on how you structure your bond portfolio at this moment?
That's a great question, and I love the build-up to the case for bonds, which is like half of what I do internally when getting shelf space or making the case versus equities, fixed income, and the rest. Agree with the framing. I mean, to Wenting's point, it really depends on what you need your bonds to do for you. If you need them for income vis-a-vis equity and REITs, in a very dividend-hungry type of market, that makes sense. That may not make so much sense to Alice's point when you compete on a relative value sense purely with the likes of T-bills right now. T-bills perform better than high yield this year. High yield's at second place, right? So this is the kind of new market we are living in, which is crazy exciting, at least compared to where we had no yields over the past 8 years. Now we have a lot of yield to play with, just where, and to your point, timing. So when constructing a diversified fixed income portfolio, today, you break it down duration and credit, if we go that way. Really easy stat, and I think both the panelists before I've tried to address this. The short duration is a gift. It's like water after being in a desert for a long time. It's such a no-brainer, but it's going to be temporary. Great mathematical stat we just worked out on the desk today as well. Perhaps in the belly, which is 5-year type of duration, it's a little bit of a sweet spot, because if rates rise another %, you won't be in a red, you won't lose money. If rates tighten another 100 basis points, you're 9%, happy days. So that's kind of the sweet spot and what we call portfolio ballast that has been restored a little bit on the duration side. Having said that, we also, make no mistake, we're entering a new regime where we are going to be higher for longer. We are holding tight at that level because of the threats to like recession and activity stagnating if and importantly inflation, right? If we don't stop holding tight at that high level. But then at that high level, which is 5%, 10 years last night, can it go to 6? Can it go to 7? There are reasons why, although we think less likely than it going to 4 or 3. We know one thing for sure, that is more macro uncertainty. More macro uncertainty whilst we chart the waters, but at the same time, you kind of have to be aware of the mega forces that are pretty structural. Like this is going to be a thing, right? AI is going to move portfolios, and AI is also, has implications on where duration goes. So holding those long, short term, I think what I wanted to bring to the table today was a little bit more on a point, maybe additive around nimbleness. So we would like to advocate perhaps for more granularity and agility in terms of portfolios. Yes, you should have your structural long-term asset allocation, diversification in the sense of equity fixed income makes perfect sense, but also diversification in the sense of toolkits, right? What is going to be your levers that you're going to be able to sell and buy more quickly, preserve your liquidity, don't bleed for 3-4% just because of T-cost. These are hard-earned day-to-day compounded returns. And that comes down to a lot of the things we've been doing in BlackRock, which is ensuring your portfolio has the right this is stuff I'm going to hold. These are the bonds. These are the single lines. Or this is the long-term equity bet that I cannot afford to lose, versus building a liquidity sleeve with whatever it is, with funds, with ETFs, with overlays for those of you who can, just to keep a fairly nimble tactical asset allocation. That's going to be a real key driving returns, we think, across the board. If we aggregate kind of all the investors' view in BlackRock. And then I would just add one point, duration we addressed. Credit risk, I think, would agree in terms of the relative value between investment grade and high yield. Investment grade super tight, Asia also super tight, and we're going to touch on that. But in a high yield space, number 2 in the rankings this year. You can't disagree with that. But the whole idea, bringing it together, is, you want that income because cash doesn't beat inflation anyway. High yield is the one who's going to give you a chance of beating inflation. Hold some of that, generate some income out of that, better value vis-a-vis equity. Hold that in an ETF, so when you need to sell it down or crank it up, it's quick and it doesn't cost you in and out, if that makes sense.
Thank you, Koay. Moving on to Hilda. I know you're an Asian credit specialist, so I think a while ago when the interest rate regimes are close to 0%, people really looked at Asian credit for a source of yield. Now, developed market yields are high. So, where does Asian credit fit into that scheme, particularly with all the volatility we're seeing in the China, property bonds and so on and so forth?
Yeah, thanks, Hugh. I think that's a really valid question and something that I've been made to think about a lot in the past 2 years or so. So I think it's true that the negative news flow within China has really weighed down returns within Asian credit and, of course, weakened investor sentiment towards the space. But I think what many investors do not realize is that outside of some of these very well demarcated weak spots within Asian credit, China property, for example, the other parts of Asian credit has actually been incredibly resilient. So, for example, Asian investment grade has actually outperformed US IG and also EM IG on a year-to-date basis. And I think looking ahead, given how high yields have repriced, as the earlier panelist has already mentioned, we are actually pretty optimistic on the total returns in Asian credit going forward. So Asian credit is currently yielding about its 14-year high as we speak. So I'll give a few reasons why. So first and foremost, from a valuation standpoint, we think Asian credit still looks attractive relative to its DM equivalents. For example, in Asian IG, it's currently yielding about 20 basis points more than US IG. It might not seem like a lot, but this also comes at about 2 years less of duration in Asia as opposed to US. So overall, I would say from a yield versus duration standpoint, Asian credit still offers value to investors as opposed to its global counterparts. And as they mentioned earlier as well, given how high yields are, the income carry component is very high and therefore also offers very strong downside protection for potential volatility ahead. And the second point, which is perhaps even more important, is that we have to remember that Asia is not just about China. And within Asian credit, we still do see many interesting alpha opportunities for the taking, and at the same time, also many places where investors can hide from the volatile world that they're facing right now. India being a very good example, to us it still remains very much as a bright spot, supported by strong services growth and also domestic demand. Of course, this also leads to positive momentum for their corporate fundamentals. And even within China, we do see nascent signs of the economy bottoming out. And although we would still advocate for a lot of caution and also selectivity within that space, I would say that the overall consumption story remains intact. And from there are also good opportunities for investors to harvest. So all in all, I would say Asia is not a uniform bloc. It is actually made up of a very diverse set of economies that's driven by very different factors. And with that, it also gives the region very low correlation as opposed to the DM counterparts. So with that, it will also mean that apart from having attractive valuations, investors also stand to benefit or harvest the diversification potential by adding Asian credit into their existing portfolios.
Thank you very much, Hilda. I think I was just looking at the Slido questions that have come in while we were speaking, and actually most of the questions are actually overlapping with, one of the questions was, some investor is actually invested in bonds 6 months ago and is underwater, and what should he do? Should he stay invested or should we get out? Does anyone want to take that question?
I think I go back to my earlier point. Actually, if we be a bit more granular with our bond allocation and just don't take bond as a, hey, I bought this 5-year or I bought this 10-year. Granted, it probably comes at a huge lot size, but with things like Endowus today, right, the MNCA, the entry barrier to bonds are a lot lower now. So we have some luxury and privilege of segmenting. So think about bonds as, what can I hold to maturity? What bits do I want to lock in, quote unquote, today, given there is potential to lock in 5-6%, versus what is more tactical than I need to play with, right? Funds, ETFs, all of that can achieve that outcome today that they cannot perhaps before. So if people are still, perhaps a bit more singularly treating that bond allocation as one single block, I think gone are those days. We hugely advocate fixed maturity pot, tactical liquid pot as your fixed income allocation.
Thank you. I'm afraid we've run out of time, but I think that the key message here is that despite the volatility and uncertainty that we're seeing, we should stay invested. We should look at particularly bonds from a total return perspective, not just yield. And when we construct balanced portfolios, it's balanced and diversified for a reason. And we need to take long-term views. And our stance at Endowus is really to take balanced and diversified views so you don't have to trade in and out and time the markets. I wish we had more time to discuss, but thanks all to the panelists today for participating in this panel. Thank you very much.